Good morning, everyone, and thank you very much for joining me. This is the morning market review. It's Friday, and it's the 16th of September 2022. My name is Russell Shaw. I'm a senior market specialist at FXCM, and my email address is rshaw@fxcm.com. Just going to go ahead and bring up the high risk investment warning. I'll keep this on screen for a few moments. And here's our market commentaries disclaimer. All right, and the references, MarketScope, TradingView, and Bloomberg, specifically the 5 things to start your day. It's an email from Bloomberg that I received. And then we'll just take a look at Japanese yen. I had an email from Rob yesterday just asking if we can take a look at it. And it's, to me, it's a very difficult, actually, analysis to make, but we'll take a look at it. Let's go through the email. The first headline reads, "Old Friends Reunion. Russian President Vladimir Putin told Chinese leader Xi Jinping he understands Beijing's questions and concerns about his invasion of Ukraine, a rare admission of tensions between the diplomatic allies. In their first in-person talks since the war began, Putin hailed the balanced position of our Chinese friends on the Ukraine crisis and offered to explain in detail our position, calling Putin an old friend. Xi said China is willing to work with Russia, display the responsibilities of the major powers, and play a leading role to inject stability and positive energy to a world in chaos. Yet Xi may continue to withhold material support as Putin suffers humiliating battlefield losses." Next headline, historic takeover. Germany is in advanced talks to take over Uniper and 2 other large gas importers in a historic step to avoid a collapse of its energy market, according to people familiar with the matter. State ownership of Uniper, VNG, and securing energy for Europe is the main solution under discussion. The government is considering buying Fortum Oge. Beg your pardon, this is a pronunciation issue for me. Is considering buying Fortum Oge's controlling stake in Uniper for a nominal price and would then inject billions of euros into the company through a capital increase. Surging gas prices and Moscow's move to squeeze suppliers to Europe have already prompted a series of government bailouts and rescue loans, but these measures are increasingly dwarfed by the scale of the crisis. The third headline, the guessing game. Federal Reserve officials could find reasons for raising rates by a full percentage point next week if they decide to look hard enough. Though the base case still looks like 75 basis points, while most economists see the smaller but still aggressive hike as the most likely outcome of the central bank's meeting, a blockbuster move is not a zero risk in the aftermath of a hot reading on August core consumer inflation. Investors ascribed around 24% odds it could happen, according to pricing in interest rates futures. Ramping up the size of tightening at this month's meeting would send a powerful message to markets, which have at times in the past few months frustrated officials. Cutting consumption. The French government just drastically stepped up its target to reduce energy consumption this winter and avoid energy outages in an apparent bid to shake up public awareness. Prime Minister Elizabeth Bourne urged households, businesses, and local and national authorities to cut their power use by 10% compared to last year, according to a presentation sent to reporters following a press conference. Emmanuel Macron's government had previously put forward a target to reduce consumption by that amount within 2 years. Meanwhile, the country's central bank slashed next year's economic growth forecast and raised its inflation outlook, painting a much bleaker picture of the outlook than the government. Coming up, European equities are on track to follow the Asian and US peers lower as investors assessed fresh China data as well as the Fed's rate path. ECP's Olli Rehn speaks at a conference. NATO military chiefs meet in Estonia. Expected data include Euro area CPI, Italian trade balance, and UK retail sales. University of Michigan consumer sentiment figures will also be monitored for any hints on the inflation outlook. All right, let's take a look at some of the charts, see if we can make some money today. Hey, Howard. Morning. Nice to have you on the webinar. All right, so I've got here Japanese inflation is considerably lower than the other industrial countries, but it's still high on a relative basis for Japan, right? So if we kind of zoom out, you can see that it has had these spikes. And what the Japanese government is effectively hoping is that this would just be another one of these spikes that that moderates. And you can see that we've got the obvious peaks in the inflation rate here, and then because there is almost, one would suggest, an inclination for the Japanese economy to exert deflationary tendencies, it seems that's probably what the Bank of Japan seems to be banking on. Now, I'm not certain that is effectively realistic. If we just go back to the 70s, perhaps a little bit more of an indication of where we're at in terms of comparative periods. Again, we've got to be careful because we don't want to be subject to a time series bias, but I would suggest sort of the 70s into the early 80s is probably more comparatively correct than any of the other spikes in inflation. If that is the case, then of course the inflationary outlook for Japan needs to be monitored, because one would expect higher prices. And the way that we can do this, of course, is with technical tools. So the one thing we can put in is, of course, a 3-month or a quarter EMA, or even a longer, make it a 12-month, make it sort of a 12-month exponential, so slightly faster than a 12-month simple. So let's throw that in and see what we get. Okay, so I'm going to put in a 12-month exponential here. Just to give it some breathing room, but still having a weight on it, so it's a little bit more receptive to data. Whilst I don't think it is the ideal indicator, because you can see there is a fair amount of volatility in the Japanese inflation. Let's throw in an RSI as well, see what kind of a reading we get with that. All right, and again, I think it's worthwhile putting in a signal line on the RSI, which I think helps for a series such as inflation. So let's just throw that in. And let's keep it at 9. Okay, and let's go back to the 70s here. Let's just see what kind of All right, so we've got an RSI so this is quite interesting. So over here, we're clearly overbought. It swings down, and then we get the moderation. It comes in, obviously, take a look at this. Loss over on the RSI, just a little quicker in terms of the signal than, say, the simple moving average. And what we have here, again, this one's more sort of in line. Again, a little quicker than the moving average, but a movement down in terms of the RSI over the signal line. What's interesting about the early 80 signal is, of course, we're not overbought there, which is overbought on these settings I regard around 80. But I think besides the overbought, the crossover signals, I think, would be primary and would trump that. And Gertie, yeah, it's an EMA. You just take a look in the top left corner. EMA over here. EMA. So here's the settings. EMA 12. I'll just double check that, but I'm fairly certain. EMA 12, yeah. Okay, cool. Again, for me, this is not a series that I look at all that often. So I think that there can be some discussion in terms what are sort of appropriate metrics to monitor. So I would certainly admit to that. But I think just as a sort of a start, what we can perhaps suggest here, and again, I'd like your comments if you have any, and I'll read them through to the attendees. But if we do have an inflation environment that is more similar to, say, the 70s, early 80s than the latter periods, then there is a good chance that we do get an overbought reading here, which we don't have yet. So that is certainly possible. And if that is still the case, then the crossover to the downside is still a fair time away. So that's the first sort of inference that comes to mind. The second inference that comes to mind is perhaps the Bank of Japan is also counting on the other central banks to tame inflation on their behalf, because we're in a global environment. Certainly the aggregated tightening should have some sort of, one would think, global impact. So that's maybe something that the Japanese are hoping. However, what I think we can say is the inflation picture is still in a markup phase. Let's use the Weinstein phrase here. It's still in this markup phase. Where it rolls over is obviously an unknown, and it's an unknown for all central banks. But it's different for the Bank of Japan because their policy response has been markedly different, and that's the big deal here. So we have a situation where, and we're looking at a headline inflation here. It's climbing. Doesn't look like the RSI has finished. In other words, we still have a potential to go overbought. And if that's the case, let's just examine Bank of Japan response. The Bank of Japan's response has been quite remarkable in this type of an environment. So what we're going to do now is we're going to look at what's called the JGBs, which is the Japanese 10-year bonds. So let's just bring that JP 10-year. Okay, so let's bring that up. Okay, and I want to just, for the time being, I want to clear out, I just want to clear out the indicators. I want to just look at the raw the raw yields. And let's just take a look at this on a weekly basis. And this is where it gets really interesting. Because what the Bank of Japan is effectively doing is they are defending this level, which is around about 25 basis points. So every time the yield approaches 25 basis points on the 10-year, they will come into the market to effectively buy Japanese bonds. Remember, you buy bonds, effectively push the price of bonds up. What do you do to the yield? The yields are inverse. It will push the yields down. So they'll come in and they'll transact so that this 25 basis point is sort of maintained. What would be interesting is just to take a look at the 2 years, just to see what's happening here. And they're negative. Okay. So while I'm looking at 2 years, 2 years is generally a very good indication of central bank policy, and negative rates are quite, let's say, unique in this type of an environment. Even the ECB, which had a regime of negative rates, no longer has that regime, right? They've gone positive, they've gone hawkish. So, and that's, I think, that's a very obvious point to make, in that the ECB, which was a very loose central bank in terms of policy, has tightened up remarkably. Not Japan. We must admit, the inflation picture between Europe and Japan is markedly different. Okay, we're talking about 7% difference, right? But the response of Japan doesn't seem to be appropriate for an inflationary environment, because we know that when there is inflation, an appropriate response would be to raise interest rates to a level to moderate that inflation, And the defense of the 10-year, of the 10-year, has actually had some remarkable results. And what is one of those results? Well, let's just take a look at US dollar, Japanese yen. And clearly, what we have here is a huge appreciation of the dollar against the Japanese yen. Let's just understand this in terms of the fundamentals. Okay, so we can see the technicals. The technicals here are as clear as can be. We are in zone 1, and not only are we in zone 1, we are in the upper quintile, and we're maintaining. And the US dollar has appreciated massively against the Japanese yen. But let's just understand the fundamentals. The fundamentals, let's go back to TradingView just to understand what's going on here. Okay. What we're going to do is we're going to take the US 10-year and we're going to subtract the Japanese 10-year. So we're looking effectively at the spread difference between the two bonds. All right, let's bring that up. Now you can see the US 10-year. I just checking myself. You can see the massive increase in the spread. And let's just put in the US dollar Japanese yen underneath this, okay, just so we can, and we'll put in a correlation coefficient as well. So let's do that. Okay, now it's a mirror image. It's a mirror image basically. Let's throw in the correlation coefficient. It should be very close to 1, I would expect. Let's just throw it in. All right, so it's not quite as high as I expecting, but it's certainly growing. So we're at 0.67. There was a time back in June was at 1. What we can say though, it's a strong positive correlation. I think there's little doubt, and the idea here is as long as the Fed remains hawkish as can be, and as long as the Bank of Japan remains as dovish as can be, one would expect the spread between the 10 years to carry on moving in this northeasterly direction. And if that's the case, then the US dollar Japanese yen theoretically should carry on moving in that northeasterly direction. Well, that means that any sort of dips or profit taking in the US dollar Japanese yen becomes hugely compelling. One would think that, well, this is almost free money because of the stark contrasts between the central banks. And of course, I think there is a certain amount of merit in that kind of thinking. However, I would urge caution because central banks do change policy on occasion, and in particular, Bank of Japan and Swiss National Bank do it on a whim. So whilst the good times are potentially lucrative, the chance of being ruined is actually remarkably high. And what we're going to do is we're going to take a look at 2015 Swiss National Bank, just to draw a parallel. I don't think that it's exactly the same, but let's just understand what happened in January 2015, because I think that highlights the risks involved when central banks are really influencing the market to a point that they're not letting market forces do their job. So once you stop letting market forces do their job, you're going to introduce inefficiencies. Now, of course, there is an argument to be made for regulation, because sometimes market forces are skewed. So there is that, but I don't believe this is one of those cases. And my opinion here is that there is outright manipulation here by the Bank of Japan to the detriment of the market. Let's go through to the Euro Swissy. How shall we do this? Let's take all of these out. And let's go Euro Swissy here. Okay. Now we want to go back to 2015 in particular. So just bear with me while here we go. All right, this is what I'm looking for. Okay. This over here, this is exactly what I'm looking for. Let's just get rid of the shading. Okay, so this was a very interesting case. Effectively, we have spoken about this previously, but it's certainly, I think, worth mentioning what's going on here. And the Swiss National Bank also was very influential in the market between, let's say, 2011 to the beginning of 2015. And the level that we're talking about is the 120. So the Swiss National Bank actually is defending the 120 against the euro. In other words, they would not let euro dip below 120 against the Swiss franc. I think about it, they wouldn't let the Swiss franc dip below 120 to the euro. Sorry, very important that actually euro, the base currency, is always going to be 1. So they were defending the 120 level. So they were keeping 1 euro equal to 120. And that was almost like clockwork. In other words, every single time the euro Swissy approached 120, you're always guaranteed of a movement or a bounce. You could sort of bank on the Swiss National Bank until you couldn't. And that was in January 2015 when they removed the floor. Once they removed the floor, anybody that was long euro Swissy was immediately wiped out. You can see. Let's just go to the daily here. Let's see if we can see how quick it was on the daily. Okay, so now we go on to daily. Let me just zoom in here. Okay, so whoever was long euro Swissy on the 15th, I think, yeah, the 15th of January was immediately wiped out. And not only was it traders that were immediately wiped out, brokers were wiped out. In fact, FXCM had to do a fair amount of work to remain sort of solvent here, because this was just a huge surprise. Nobody saw it coming, and it just was a black swan. I can't think of any better example of a black swan event here, which of course now brings us back to the US dollar Japanese yen. The US dollar Japanese yen may not have something as vicious as that, but I don't know. You see, what's happening here, in my opinion, is that there is inefficiencies that have been introduced by the Bank of Japan, just like there was inefficiencies that were introduced by the Swiss National Bank. Now, what happens when you introduce inefficiencies is you are, in fact, generating potential energy. Just to explain what I mean by that. The euro Swissy, by all rights, should have been below 120. So the more that the fundamentals suggested that it should be below 120, and the more that 120 was defended, I guess the heavier the task of defending that 120, to the point that when it actually gave way, all that potential immediately transfers into kinetic. It becomes sort of, from potential, it becomes active energy, and it moves at a rate that just is completely destructive. So I don't know if that is going to be the case, but I would imagine if the Japanese inflation carries on moving according to that 70s, early 80s type of scenario, then that 25 basis points is going to become harder for the Bank of Japan to defend. Now, what they can do is they can alter target. They can say, well, we're not going to defend 25 basis points. We're going to start defending 30 basis points. They can say we're going to start defending 40 basis points, or they can abandon the defense altogether. Either choice is going to have huge ramifications for the US or the Japanese, because that potential is going to transfer into kinetic. Gurdeep's just called that Black Wednesday. So I hadn't heard that before. I'm not sure. Is that the actual name, Gurdeep? I don't know, but I would imagine that it's quite appropriate. So the point here actually is, yes, US dollar Japanese yen does seem like a good play at the moment. It certainly seems like a good play at the moment. But all it takes is one change by the Bank of Japan to completely wipe your account. Now, the idea is, oh, okay, for sterling, okay. So the idea here is you can set a stop loss. It's not going to help if we have that black swan event. It's not going to help. Why? Because there's going to be no bids at your stop loss price. By the time the bid comes in, your account's going to be wiped. So you've got to be very, very careful about these type of opportunities. Again, I of course don't know, nobody knows what the Bank of Japan is going to do, except the people that do. But it's not a place that I'm interested in myself. It's not a place. So just understand, yes, this is going to work like clockwork until it's not. Now, by the way, as a business, this has huge ramifications. I spoke to our risk manager about this, because if there is any sort of movement here, of course, any positions where FXM's on the opposite side will have devastating effects if there is a black swan event. So we've had to kind of acknowledge that and take steps to make sure, everything is risk appropriate. So the idea here is, heightened risk. So that's my view. It's subject to correction, of course, but I do want to encourage a certain amount of caution here. I hope that helps, Rob. Again, it's not something that I've put too much time into. It's not something with too much time to really analyzing. I've got to give it some more thought. But that's kind of the first thoughts that came to mind. I want to also just talk about something else before we wrap up for this morning, and that is on the US side of things. So yesterday, the 2-year yield moved. It's not just yesterday. It's actually since the CPI announcement. But the US 2-year yield here is rampaging. Okay, so let's just bring that up. Do I think we should stay out of the US dollar basket? Rob, that's a very good question. What Rob's effectively asking here, I'll admit, Rob, I haven't given this much thought, and it does need that thought. So the US dollar basket, which is the FXCM, let's just bring that up, we'll come to the 2-year now, is an equally weighted basket, and of course the US dollar Japanese yen is a part of this basket. You've got the euro, you've got the pound, you've got the Aussie, and I think the Canadian. So I think those 5. I think there's 20% apportioned to each of those. So then the obvious answer to that is, if there is some sort of event, Rob, it does seem as if the US dollar basket would probably be at risk, or at least one fifth of it should be at risk. Let me give that some more thought, Rob. It's an excellent question. My first instinct is yes, there would be an influence. The DXY, by the way, would have less of an influence. The DXY is a trade-weighted dollar index. The DXY is actually heavily influenced by euro. It's heavily influenced by euro. So in this case, the US dollar, the FXCM US dollar, which I think is actually a really good instrument, is probably more at risk than, say, the DXY. So that was a really good point. Let me give that some thought. I just want to bring up this US 2-year. All right, so this is a 2-year. It's rampaging. Look where we are, 3.9%. Okay. Now, again, the 2-year is a very good proxy for central bank policy. Since this is kind of where the CPI number missed, you can see how aggressive the market is now moving the yield up. What we're going to do here is just to make this a 5-year. What we're going to do here, we're going to put the Fed funds rate on top of this. Let me actually move it out even more. And let's put the Fed funds rate on top of this. All right, and let's just make this. Sorry, let me just make this sort of a deeper black. Just I think it's easier to see. So the candles, I beg your pardon, are the 2-year. The line chart is Fed funds, and you can just see the correlation here is incredibly strong. So we are on the Fed funds rate. So it reads at 2.33. So US interest rates, by the way, are moving a band just because of their interest rates. So we can use 2.33 as a proxy. But as the 2-year moves up, what it's effectively telling us, considering how close the correlation is here, well, it's suggesting that the Fed funds rate has to follow up. Now, there have been overshoots, of course, so it's not a 100% done deal. Maybe the 2-year is overplaying its hand, so to speak. But so back in 1994, there's an obvious overshoot. Yeah, the Fed funds rate didn't follow the 2-year up here. But I think that we must acknowledge that there is a strong probability of Fed funds rate following 2-year up here, just based on the inflation miss and the communication coming out of the Fed. So the 2-year here is suggesting, of course, higher interest rates. Base case 75 points next week, but the article that we read this morning said 24% chance of a 100 basis points. Yesterday, when I looked at the probabilities, I saw it as 26%. I'm not sure if there's been some movement between now and then, but of course, there is talk of 100 basis points coming in. My feeling is 75. My feeling 75. I think 100 is going to be disruptive. So I think 75. But as long as this 2-year keeps moving up, we're not moderating here. And the key here. So there's two things that we need to just discuss, and then we'll end for the morning. The first thing that I'd like to discuss is the median CPI. We have mentioned this previously, but I want to definitely draw your attention to it again, because I think this is sort of the make or break. I think it's this median CPI. Effectively, let's take this out. Effectively, what the median is, I think we're missing a data point here, but I did look at it on the Fed website. There's still no signs of moderation. I think this is missing a data point, but the idea here is, even if we get some sort of moderation on PCE, even if we get some moderation in core PCE, even if we get some moderation in core CPI, that moderation is going to be short-lived unless there is moderation in the median. In other words, if the median doesn't start backing down, it's going to put a floor underneath the core numbers. So we might moderate, say, from 8 through to 7 or 6, sort of on a headline. We might moderate from a sort of a 6 through to a 4 on a core basis CPI. On the PCE, we might moderate, say, from a 4.7 to a 3.7. I'm obviously just sort of making these numbers up, but the point is there's going to be some sort of floor that it won't be able to drop below unless there is moderation in the median. So this median here, I think, is actually the make or break. In other words, even if there is good news in the next month or the next 2 months, and that leads to some sort of risk on movement, those are going to be very suspect unless the core number, unless the median rolls over. In other words, those are probably bear market rallies until until median inflation starts coming under control. So that's the first thing I wanted to show you at this point of the webinar. The second thing I want to show you at this point of the webinar is the yield curve. So let's just throw this in. So we're looking at the 2s, 10s, right? So you'll just take the 10, you'll subtract the 2s from that. And what we saw is the rampaging 2-year, which is at now 3.9%, right? It's absolutely rampant. And what that's effectively done is it's pushed the yield curve deeper into negative territory. So that it's increased the inversion. We're now at minus 4.3, so we're getting pretty close to sort of on this particular inversion, the deepest we've been is around about minus 0.5. So we're getting pretty close to that. Now, the deeper the inversion goes, the more serious the outlook. The longer we stay inverted and the deeper we go, the more serious the outlook. So we've been inverted now for about 54 days. I counted it yesterday, so I just went to the daily and I just counted all the candles. I counted, I think, 53 yesterday. I think this must be the 54th. In other words, the Fed is now, I think there's little doubt the Fed is starting to manufacture a recession. And the reason they warned about this at Jackson Hole. So they fighting inflation tooth and nail. They admitted there's going to be some pain, and the inversion here, I think, needs to be considered in terms of unemployment, which is looking remarkably strong, actually. My feeling is the longer we stay inverted, the deeper we go, the unemployment situation inevitably must weaken. Inevitably, it must weaken. And the reason it's going to weaken is because an inverted yield curve is showing what we call demand destruction. Higher interest rates means that we will demand less. It means that in this kind of high-risk scenario, we would prefer havens that give us interest, which would be the 10-year. So if we buy into 10-year bonds, we support the price. It means we keep the 10-year yield fairly dampened, which means that the inversion prolongs. And that's what I noticed yesterday. So we just want to keep an eye on this. So we certainly do have cause for concern. We'll monitor next week again how the COPOC is looking. We'll look to see if there is prospects of bottoming out. But the rampaging 2-year yield at the moment is problematic. And I think that we need to just recognize that. Howard's just asking, when is the traders webinar registration out? It's been sent out. There was an email that was sent out. Anybody that hasn't got it can email me. I spoke to Anna yesterday, so there's obviously an issue with the EU side of things because I'm not actually allowed to deliver to the EU. So just I think keep that in mind. But if you want to register and you haven't, just send me an email. The sessions, by the way, are going to be recorded. So at some stage, they'll be available, but we are going to delay. We're going to delay the recordings. I'm not sure what the delay period will be, but there is going to be a delay. All right, I think we can wrap up there. Sam's asking, how important is preliminary University of Michigan? So I think that consumer sentiment is important. Let's just bring that up here, Sam. So I think what we're going to look for here is two things. We want to look, Sam, at there's going to be an inflation sort of reading, and I think so. Effectively, the University of Michigan surveys are split between consumer sentiment and inflation. So they'll ask a fair amount of questions on where do you see prices in the next few months, etc. So that's something that we wanted to see if, because the inflation expectations actually were dropping. So we want to just keep an eye on that. And then it's still very suppressed. The consumption here does certainly need a pickup. You can see that it's not looking particularly good at all, Sam. So I would keep an eye on it for sure, because consumption is a huge part of the economy. There was one more thing that came to mind just before we do sign out. One last thing. Yesterday we had the Empire manufacturing and we had the Philadelphia manufacturing numbers coming out, and they were poor numbers. However, of interest, the inflation component of those series is down, by the way, which I think would be pleasing to the Fed. But of course, we need to see more data that suggests a trend of moderation. And even if we get that trend, remember, we really need to get that median number under control. Once that median number's starting to show signs of moderation, I do think that we can start talking about when will the COPOC turn up? Is this a good time to be looking for a bottom? But that median number is very sticky at the moment, and we just need to keep on top of that. Alrighty, Sam, did that answer your question? We definitely need to see the consumer sentiment's important. All right, let's wrap up here, guys. I will chat to you on Monday. Have a good day, good weekend ahead, and we'll chat on the other side. Nice, Rob. Nice. All right, guys. Wrapping up here. Cheers.